No one expected it to play out like this. XRP finally gets the institutional breakthrough investors. Waited years for 3 ETFs, hundreds of millions in inflows, and the backing of trillion-dollar asset managers, yet the price falls. Instead of a victory rally, the market delivers a 12% plunge, whales unload 200 million tokens, and retail traders are left wondering how a flood of new demand can collide with one of the sharpest sell-offs of the year. What we're witnessing isn't just volatility, it's a rare dislocation between what the charts show and what the institutions are doing behind the curtain. XRP is rising in one world and sinking in another, and that's where the real story begins. Ripple's ETF moment wasn't supposed to look like this. When Canary Capital launched the very first spot XRP ETF on November 13th, the numbers were explosive: $58 million in day one volume, outpacing more than 900 ETF launches this year. Within 72 hours, inflows crossed $268 million, making it the strongest debut of 20. And then the pattern repeated. Amplify entered the arena, and Franklin Templeton followed with its XRP ETF, backed by more than $1.5 trillion in assets. Analysts began projecting as much as $7.2 billion in XRP inflows over the next 12 months. Everything signaled a historic shift, the kind of institutional validation that usually lifts a market out of gravity. But instead of launching a new trend, the ETFs triggered the same reaction Bitcoin saw in 2020. Optimism at the front, followed by a sharp, almost mechanical sell the news drop. A rare moment where the launch meant to ignite the market ended up exposing its deepest fragility. Most traders look at the charts and assume ETF inflows should push prices up instantly. But XRP's new ETFs operate under a mechanism the public rarely sees, and it explains why the market feels disconnected from reality. According to Fabio Marzella at the XRPL Foundation, every dollar flowing into these funds doesn't reach the market the moment an investor clicks buy. ETFs work on a delayed T+1 settlement cycle, meaning the money only arrives a day later, and even then, much of the accumulation happens quietly, far from the exchanges retail traders watch. Issuers source XRP through over-the-counter desks, private liquidity pools, and authorized participants that never touch public order books. So the real buying pressure gets buried, absorbed off-chain, invisible to on-chain trackers, and completely missed by price action in the short term. What looks like a weak market is actually a slow fuse burning beneath the surface. And once these hidden inflows settle and finally appear in custody reports, the impact could arrive all at once. While institutions were quietly accumulating XRP through ETF channels, another force moved even faster and far louder on the open market. Within just 48 hours of Canary's ETF debut, whales offloaded nearly 200 million XRP, a wave of distribution powerful enough to flip optimism into a sharp correction. It wasn't announced, it wasn't coordinated, it simply happened, the kind of behind-the-scenes activity that drains liquidity before traders even realize what hit them. As sell orders cascaded across exchanges, derivatives markets buckled, wiping out more than $43 million in positions overnight. But the deeper issue wasn't the liquidation, it was sentiment. Nearly 41% of all XRP is now held at a loss, creating a fragile psychology where any burst of volatility turns holders into sellers. The ETFs brought long-term confidence, but the whales reminded everyone that short-term control still belongs to those who can move hundreds of millions of tokens without warning. And once they made their move, the rest of the market had no choice but to react. XRP's chart tells a quieter story, one that doesn't shout but whispers a warning. After the ETF excitement faded, the technical structure began to slip, like an aircraft losing altitude long before anyone notices the turbulence. XRP now trades beneath every major exponential moving average, the 20, the 50, the 100, even the 200. Each one has flipped from support into resistance, forming a layered ceiling that rejects every recovery attempt. Momentum confirms the pressure. RSI sits weak at the high 30s, MACD drifts deeper into negative territory, and the parabolic SAR dots hover stubbornly above price, signaling that sellers still dictate the pace. But the bigger picture is the pattern forming around all of this, a massive symmetrical triangle stretching from the 390 high down toward 1180 support. XRP has fallen into the lower half of this structure, where every bounce fades faster, every rally gets thinner. Support at 215, then 210, then the high-volume node at 205 becomes the narrow runway holding the market together. One slip beneath 205, and the structure opens into the same 1180 zone that marked the last great accumulation phase. XRP isn't crashing, it's compressing, tightening, drifting lower, waiting for a catalyst strong enough to lift it back above 240 cent and break the downward pull. Until that happens, the market remains in a slow descent. Fear has a way of distorting every signal on the chart, and right now it's sitting at its highest level of the year. The Crypto Fear and Greed Index has plunged to 15, matching the same reading that preceded XRP's explosive rebound earlier in 2025, when the token rocketed from 1179 to 3.54 times in just 3 months. But this time, the fear feels different. It isn't just about XRP. It's the macro pressure tightening around the entire market. Bitcoin can't reclaim 90,000s. Ethereum drifts toward $3,100 with no real bid stepping in. Liquidity across altcoins is drying up, leaving even strong tokens vulnerable to sudden drops. In markets like this, fundamentals stop mattering, at least temporarily. Traders sell not because the asset is weak, but because everything around it is sinking. It's the kind of environment where even good news gets buried, where inflows feel irrelevant, and where every small dip looks like the start of something worse. And yet buried inside this fear is the same pattern the market has seen before. The moment when sentiment hits rock bottom, long-term buyers quietly return. Fear doesn't last forever, but when it reaches its peak, that's when the next phase usually begins. Fear doesn't announce itself in the crypto market. It slips in quietly, spreads through every chart, every candle, every trader's decision, and then suddenly it takes over everything. That's exactly where we are now. The Crypto Fear and Greed Index has crashed to 15, a level so low it only appears during moments the market wants to forget. The last time we saw this number, XRP was preparing for a 96% rebound, but this time the fear feels heavier, thicker, almost structural. Bitcoin can't hold $90,000. Ethereum drifts toward $3,100 like a ship losing power. Liquidity is thinning across every major exchange. Even strong assets move like they're carrying weight on their backs. This isn't just price weakness, it's a psychological compression, a moment where traders stop looking at fundamentals and start reacting to shadows. Every dip feels dangerous, every bounce feels temporary. Good news gets ignored, bad news gets amplified, and even ETFs worth hundreds of millions barely make a dent in sentiment. But buried inside this panic is something the algorithms can't read: exhaustion. Markets can stay fearful for a long time, but they can't stay at peak fear forever. And when sentiment finally snaps from fear to neutrality, even briefly, the assets with real fundamentals tend to move first. XRP has been here before, and what happens when fear breaks could matter more than the fear itself. While XRP's price struggles under the weight of fear and whale-driven volatility, Ripple itself is quietly expanding in a way the charts fail to capture. It's one of those rare disconnects where the asset looks weak, but the ecosystem behind it grows stronger than ever. Ripple's RLUSD stablecoin has surged from a modest $50 million to more than $1 billion in market cap, 20 times growth in a single year. That kind of adoption doesn't come from hype, it comes from real institutions integrating real settlement flows. At the same time, Ripple Prime is starting to reshape corporate payments from the inside. The platform now moves over $2 billion in monthly settlement volume, offering banks and financial firms a compliant direct path into Ripple's infrastructure. This isn't speculative trading, it's enterprise usage, the kind of activity that builds a foundation far more durable than a price spike. And here's the twist the market keeps missing. ETF inflows and RLUSD adoption are not separate stories. They're two sides of Ripple's transformation, one pushing capital in through regulated financial rails, the other pulling liquidity through real-world utility. It creates a dual channel of demand that isn't reflected in spot price yet, but slowly tightens supply behind the scenes. XRP's chart may show contraction, but Ripple's network metrics show expansion. And in every previous cycle, fundamentals like these eventually overpower the fear on the screen. ETF accumulation doesn't follow the rhythm traders are used to. It builds in waves, quiet, steady, almost invisible, and then suddenly it reshapes the entire market. XRP analysts like Chad Steingraber outline two possible paths for how these new funds may accumulate supply, and both lead to the same destination, but by very different routes. In the first path, ETFs move slowly, gathering XRP through OTC desks month after month. The price barely reacts at first. It feels dull, even disappointing, as if the inflows don't matter. But behind the scenes, circulating supply thins out, liquidity tightens, the market grows hollow, and when demand finally spikes, there's simply not enough XRP left on exchanges to fill it. That's when prices move fast, not because of hype, but because the market quietly ran out of tokens. The second path is the opposite: rapid accumulation. A sudden wave of ETF buying forces issuers to secure massive amounts of XRP all at once. Spot markets heat up, shorts panic, and price discovery accelerates before retail traders even understand what's happening. It's the kind of ignition that turns a sideways chart into a vertical one, compressing months of movement into days. The irony is that traders keep watching candles, trying to guess which path will unfold, while the real story is happening off-chain inside custody reports and OTC settlements. Whether the ETFs choose the slow burn or the sudden ignition, both outcomes eventually push XRP into the same territory, a market where supply gets tighter, institutions hold more, and every rally carries more force than the one before. XRP is now sitting in a place every trader fears, and every analyst watches, a point where the chart tightens so much that the next move becomes unavoidable. For weeks, high-frequency traders have boxed the price into a narrow corridor between $2 and $2.25, squeezing volatility, draining momentum, and building pressure like steam inside a sealed chamber. Every rally gets sold, every dip gets bought. The triangle forms tighter and tighter, until even the smallest spark can decide the entire direction. This is what compression looks like. Not chaos, but silence before the break. Below XRP lies the final line of structural support at $2.05, a level that has defended the market since September. Hold it and the chart has room to reset. room to reclaim $2.48, even push toward the $2.85 resistance cluster once ETF inflows finally surface on-chain. Lose it, and the structure opens into the same $1.80 zone that marked the last major accumulation cycle. Everything depends on which side cracks first. What makes this moment so tense is the mix of forces pulling in opposite directions. Whales are still distributing, ETFs are still accumulating, retail is scared, institutions are steady. It's a market being stretched from both ends, waiting for the imbalance to resolve, and when compression breaks up or down, it rarely moves slowly. History shows XRP can swing 25 to 40% in a matter of days once a pattern like this gives way. XRP stands on the edge of that moment right now. Not falling, not rising, just holding its breath, waiting for the force strong enough to decide what comes next. In the end, XRP's story comes down to two forces moving in opposite directions, one visible, one hidden. On the surface, the market looks fragile. Whale selling, leveraged liquidations, and a fearful macro backdrop keep price pinned below every major resistance. Traders see weakness, they see volatility, they see a token that can't seem to escape its own gravity. But beneath that turbulence, something very different is unfolding. Institutional inflows keep rising. Ripple's network keeps expanding. Stablecoin adoption accelerates. Settlement volumes grow. And ETF issuers continue quietly absorbing supply through channels most traders never see. These two forces don't cancel each other out, they build tension. One pushes down in the short term, the other pulls up in the long term, creating a rare dislocation where fundamentals strengthen while price lags behind. Markets don't stay in that kind of imbalance forever. Eventually one side wins. Either fear breaks the remaining support, or institutional demand finally outweighs the selling and forces a recalibration the charts haven't priced in. XRP stands exactly at that intersection now, a token caught between panic and progress, between speculative exhaustion and structural growth. And when those two forces collide, the resolution tends to be decisive. It won't be a small move. It won't be gradual. It will be the kind of shift that defines the next chapter of XRP's trajectory. For now, the market waits, but the imbalance is already in motion.